Is your retirement income at risk because of changing interest rates? With rates constantly shifting, it can feel like a roller coaster trying to figure out where to put your savings. One minute, your high-yield savings account is earning decent returns. The next, those rates drop, and suddenly, your money isn't working as hard as it could be. And what about your bonds or annuities? Do you lock in now or wait to see where the rates go? In this video, we're tackling these exact questions. We'll explain how rising or falling interest rates impact your savings accounts, CDs, bonds, and annuities, and show you how to make smart, informed decisions that protect your financial stability. You'll get clear, practical advice on whether to lock in rates or keep your options open. And we'll even explore alternative income sources that can help you stay ahead of the game, no matter which way rates move. So, if you're feeling unsure about where to put your money or how to plan for 2025, stick around. We're going to break it all down, step by step, and help you find the best path for your retirement savings. The role of interest rates in retirement planning. Interest rates play a crucial role in retirement planning, especially when it comes to how retirees manage their savings. When interest rates rise, savings accounts, bonds, and fixed income products often offer higher returns, which can be a relief for those relying on these vehicles to generate income. On the other hand, when rates are low, the income generated from these types of accounts is reduced, forcing retirees to seek other ways to make their money last. Let's start with savings accounts. These are often seen as a safe place to park money, but the returns depend heavily on interest rates. In times of high interest, savings accounts offer better yields, making it easier to grow your money with little effort. When interest rates drop, however, the returns on these accounts can be disappointing, prompting some to explore other options. Bonds are another key element of retirement planning. They are often favored because they provide predictable income, but they are also directly affected by interest rates. When rates go up, bond prices tend to fall, since new bonds issued at higher rates become more attractive to investors. This can be tricky for retirees holding older bonds that pay lower interest. Conversely, when rates fall, the value of existing bonds rises, benefiting those who already hold them. Understanding this inverse relationship is vital for retirees aiming to balance income and risk. Fixed income products, such as annuities or certificates of deposit, CDs, are designed to offer steady payouts. Like savings accounts and bonds, their returns are closely tied to interest rates. Higher rates mean higher payouts on new products, but if retirees lock in at lower rates, they may feel stuck when rates eventually rise. Timing is everything, and choosing when to commit to these types of products can significantly impact the income retirees receive. Looking back at interest rate trends over the past few decades, there have been notable shifts that have shaped retirement strategies. In the late 2000s, for example, the financial crisis led to historically low interest rates as central banks attempted to stimulate the economy. These low rates, which persisted for years, posed challenges for retirees as the return on savings and fixed income investments shrank. Many had to adjust their financial plans or consider riskier investments to make up for the shortfall. In more recent years, we've seen rates rise in response to inflationary pressures, which has been a welcome relief for those relying on interest income. But it's also made borrowing more expensive, which can affect decisions around retirement spending and debt management. As we approach 2025, many are wondering what's next for interest rates and how these changes will affect their financial plans. Will rates continue to climb, or could we see a reversal? In the next section, we'll explore the predictions for 2025 and explore how retirees can position themselves to take advantage of or protect against these shifts. Predictions for interest rates in 2025. Looking ahead to 2025, interest rates could go in one of two directions, and several economic factors will likely play a part in determining which path they take. Inflation is one of the biggest drivers of interest rates. If inflation remains high, the Federal Reserve may raise rates to cool things down, making borrowing more expensive and saving more rewarding. On the flip side, if inflation is tamed and the economy starts to slow, rates could be cut to encourage spending and investment again. Employment rates also play a crucial role. If job numbers are strong and wages continue to rise, the economy might handle higher interest rates without too much disruption. In this case, the Fed could justify keeping rates elevated or even increasing them further. However, if unemployment starts to creep up, the Fed may be forced to lower rates to stimulate job growth and economic activity, which could offer some relief to borrowers but reduce returns for savers. Let's explore two possible scenarios for 2025. In the first scenario, interest rates rise. If inflation remains persistent and the economy stays resilient, the Federal Reserve might decide to push rates even higher to keep prices in check. For retirees, this could mean better returns on savings accounts, CDs, and other interest-bearing products. However, it might also lead to increased borrowing costs, making it more expensive to take out loans or carry debt into retirement. Rising rates could also lower the value of existing bonds, which may hurt retirees who rely heavily on fixed-income portfolios. So, while the short-term gains from higher rates may look appealing, the long-term impact could be more complex, especially for those with a significant portion of their retirement savings tied to bonds or other fixed-income products. In the second scenario, interest rates fall. This could happen if inflation cools significantly or if economic growth slows. The Federal Reserve might lower rates to encourage spending and investment, which could boost the economy, but at the cost of reducing the returns on savings products. Retirees might find themselves earning less from their savings accounts or annuities, and they may need to look for other income sources to maintain their financial security. The upside to lower rates is that bond prices would likely rise, benefiting those holding bonds from previous years. Additionally, for retirees considering borrowing, such as taking out a reverse mortgage or refinancing debt, lower rates could offer more favorable terms. With these potential shifts in mind, it's clear that both rising and falling interest rates carry their own set of opportunities and challenges for retirees. What happens next will depend on a mix of factors like inflation, employment rates, and the Federal Reserve's policies. The key for retirees will be staying informed and prepared to adapt their strategies accordingly. Next, we'll look more closely at how interest rate changes specifically affect savings accounts and other fixed-income products, helping you decide when to lock in rates or explore alternative options. Savings accounts and interest rate changes. When it comes to savings accounts, even small changes in interest rates can make a noticeable difference, especially for retirees who rely on interest income. If interest rates rise in 2025, retirees with money in savings accounts, particularly high-yield accounts, could see better returns. This means that their money will grow faster simply by sitting in the bank. For those looking for a low-risk way to preserve cash, this can be a great option. High-yield savings accounts, which typically offer higher rates than traditional accounts, become even more attractive in a rising rate environment because they'll likely adjust to reflect the higher market rates. However, while rising rates might seem like an obvious win for savers, there are a few downsides to consider. One of the main issues is inflation. If inflation continues to climb, even higher interest rates on savings accounts may not keep pace with the rising cost of living. In other words, while your savings might be growing, the purchasing power of that money could be shrinking, making it harder to cover everyday expenses in the future. Another potential drawback is the temptation to keep too much cash in savings accounts. While it's great to have easy access to funds, the returns, even in high-yield accounts, may still fall short compared to other investment options, especially in the long run. Now, let's look at the other side. What happens if interest rates fall? Lower interest rates would mean that savings accounts, including high-yield ones, offer much smaller returns. This can be particularly frustrating for retirees who are counting on that interest to help cover their monthly expenses. In this case, keeping large amounts of money in savings accounts might feel less rewarding, as the money grows at a much slower pace. However, savings accounts are still the safest place to store money, so for retirees who prioritize security over growth, keeping some funds here could still make sense. For those looking to manage these changes effectively, it's important to stay flexible. If rates rise, consider moving more cash into high-yield savings accounts to take advantage of the higher returns, but also watch inflation closely to ensure your savings are growing in real terms. On the other hand, if rates fall, it might be time to explore other options, such as moving some of that money into investment vehicles with higher potential returns, like bonds or CDs, which often respond differently to interest rate changes. Speaking of alternatives, many retirees turn to bonds and fixed income products when interest rates are fluctuating. These can offer a more stable return, especially when savings accounts aren't yielding enough to meet financial goals. Let's dive into how bonds and other fixed income investments respond to interest rate changes and how they might fit into your retirement strategy. Bonds and fixed income investments in 2025. Bond yields and interest rates have an inverse relationship, meaning that when interest rates rise, bond prices generally fall, and when rates drop, bond prices increase. This is because new bonds are issued with higher rates during a period of rising interest, making older bonds, offering lower yields, less attractive. As a result, their prices drop in the market. On the flip side, if interest rates fall, older bonds with higher rates become more valuable, driving their prices up. Understanding this relationship is essential for retirees, as it affects how much income they can expect from their bond portfolios and the value of the bonds they already hold. In 2025, if interest rates rise as some predict, retirees holding older bonds might see the market value of those bonds decrease. However, if they hold the bonds to maturity, they will still receive their original interest payments, so the income stream remains steady, even though the bond's resale value has dropped. For retirees who don't need to sell their bonds early, this stability can be reassuring. But for those who want flexibility in their portfolios, rising rates may make it more appealing to shift towards newer bonds or other fixed income products that offer better yields. Government bonds, such as U.S. Treasury bonds, are often seen as the safest investment, backed by the federal government. While their returns tend to be lower than riskier bonds, they become more attractive in times of rising rates because they offer steady, reliable income. If rates rise, newer government bonds will provide higher yields, which could be beneficial for retirees seeking safety and modest growth. However, when interest rates fall, these bonds can be harder to rely on for meaningful returns, so retirees may need to weigh their preference for security against the potential for higher income elsewhere. Corporate bonds typically offer higher yields than government bonds, but they come with greater risk. If rates rise, companies issuing new bonds will need to offer higher returns to attract investors, which could benefit retirees looking for better income. However, corporate bonds can be more volatile, especially if the economy weakens. In a falling interest rate scenario, the value of existing corporate bonds would rise, benefiting those who already hold them. But as with all bonds, it's important to assess the creditworthiness of the company issuing them, as default risk could wipe out the benefits of higher yields. Municipal bonds, which are issued by state and local governments, often offer tax advantages that can be particularly appealing to retirees in higher tax brackets. In a rising interest rate environment, newly issued municipal bonds will provide higher yields, though the tax-free income can help offset some of the sting from rising inflation. However, like corporate bonds, these are not without risk. In a falling rate environment, the value of existing municipal bonds will increase, but retirees need to ensure the issuer remains financially stable to avoid potential defaults. So, what does this mean for retirees in 2025? If you're focused on securing income and have a low tolerance for risk, government bonds might be the safest choice, particularly in times of uncertainty. For those looking to strike a balance between income and risk, corporate bonds could offer higher returns, but they require more careful consideration of the issuing company's financial health. Municipal bonds could be a great option for tax-conscious retirees, particularly if they're looking for a mix of steady income and tax savings, though attention must be paid to the stability of the issuer. The key takeaway is that retirees should diversify their bond portfolios to match their risk tolerance and financial goals, adjusting as interest rates shift. Now that we've explored how bonds respond to changing rates, let's turn our attention to other fixed income products, like CDs and annuities, which offer additional ways to generate stable income in retirement. Certificates of deposit, CDs and annuities, safe havens or risky bets. Certificates of deposit, CDs, and annuities are both popular options for retirees seeking stable, predictable income, and interest rate changes can significantly affect how attractive these products are. When rates are rising, CDs tend to offer better returns, which is appealing for those looking to grow their savings with minimal risk. But should you lock in a CD rate now or wait for rates to rise further? That's a key question retirees face in 2025. If you lock in a CD rate now and interest rates continue to rise, you may miss out on higher returns. But on the flip side, waiting too long could leave you stuck with lower yields if rates unexpectedly drop. For retirees, one approach is to consider laddering CDs, which means purchasing multiple CDs with varying maturities. This strategy allows you to take advantage of rising rates while still securing part of your savings at current rates. Short-term CDs offer flexibility. If rates rise, you'll be able to reinvest at higher rates sooner. Long-term CDs, on the other hand, offer the benefit of locking in a rate for several years. But there's the risk that better opportunities could arise later. It all comes down to your comfort with risk and whether you value certainty over potential gains. Annuities work a bit differently, but are equally sensitive to interest rate fluctuations. When you purchase an annuity, you're essentially buying a guaranteed income stream, often for life. The income you receive depends on a few factors, including interest rates at the time of purchase. When interest rates are high, insurance companies can offer better payouts because they can invest your money at higher yields. So, if rates rise in 2025, it could be a great time to lock in an annuity, ensuring you receive a higher guaranteed income over the long term. However, if rates fall, the income offered by new annuities will decrease, making them less attractive. One advantage of annuities is that they provide peace of mind by ensuring a consistent income, no matter what happens in the market. But retirees should be aware that once an annuity contract is signed, the terms are typically fixed, meaning you may miss out on better interest rates or investment opportunities later. That's why it's important to carefully consider the timing and terms of the annuity before committing. If you're risk-averse and prefer the certainty of a fixed income, an annuity might be a solid option, particularly if you lock in during a period of rising interest rates. For those who prefer more flexibility, waiting to see where rates go or exploring other options could make more sense. Either way, it's essential to weigh the pros and cons based on your personal financial goals. Now, let's explore some alternative retirement income sources that can provide flexibility and growth potential. even in a changing interest rate environment. Alternative retirement income sources to consider. For retirees looking to diversify beyond traditional savings accounts or bonds, dividend-paying stocks and real estate investments can be excellent ways to generate income while potentially hedging against interest rate fluctuations. These options come with their own benefits and risks, but when managed thoughtfully, they can complement more conservative strategies like CDs or annuities. Let's start with dividend-paying stocks. These are shares of companies that regularly distribute a portion of their profits to shareholders in the form of dividends. For retirees, this can be a reliable source of income, and it often grows over time as companies increase their payouts. One of the main benefits of dividend stocks is that they can provide both income and potential growth in your investment. Even when interest rates rise or fall, companies that consistently pay dividends tend to be more stable, making them a good option for retirees looking to maintain cash flow without being overly exposed to market volatility. However, it's important to remember that dividend-paying stocks are still stocks, which means their value can fluctuate. If the market takes a downturn, the price of the stock can drop, which could impact the overall value of your portfolio. And while many companies aim to keep dividends steady, there's always a chance that a company could reduce or even suspend its payouts if it hits financial trouble. That said, by choosing well-established companies with a strong track record of paying dividends, retirees can reduce some of this risk while still benefiting from the potential for higher returns compared to fixed income products. Real estate investments are another option worth considering. Investing in real estate can provide steady income through rental properties or real estate investment trusts, REITs, which allow you to invest in property without the hassle of being a landlord. Real estate tends to hold its value well over time, and rental income can increase with inflation, making it a good hedge when interest rates are fluctuating. For retirees, owning rental property or shares in a REIT can generate a reliable income stream while also benefiting from property value appreciation. The downside, of course, is that real estate requires more management than passive investments like savings accounts or bonds. Owning rental properties means dealing with tenants, maintenance, and potential vacancies, all of which can be stressful. REITs, while more hands-off, can still be affected by interest rate changes, as higher borrowing costs can impact real estate companies' profits. But for retirees willing to take on some risk in exchange for the potential for higher returns, real estate can be a valuable part of a diversified portfolio. Let's move on to explore when retirees should consider locking in rates and when they might benefit from keeping their options open. When to lock in interest rates or seek flexibility. Deciding when to lock in interest rates can be a crucial step for retirees looking to ensure financial stability, particularly with CDs, annuities, and other fixed income investments. Locking in rates can offer a sense of security, knowing that your income is predictable no matter what happens with the economy. But in periods of fluctuating interest rates, flexibility might also be worth considering. Let's break it down. For retirees who prioritize stability and don't want to worry about interest rates dropping in the future, locking in rates through long-term CDs or annuities can be a smart move. With a long-term CD, you're guaranteed a specific rate for a set period, which means your savings will grow steadily, even if market rates decline. Similarly, annuities offer a fixed income stream that won't be affected by future interest rate changes, making them a reliable choice for those seeking predictable income in retirement. The main benefit here is peace of mind. No surprises, no need to constantly monitor the market. However, the downside of locking in rates is that you could miss out on better returns if interest rates rise later. For example, if you lock in a long-term CD today and rates go up next year, you're stuck with the lower rate, while new investors benefit from the higher returns. The same goes for annuities. Once you lock into a rate, it's typically set for the duration of the contract. This is why some retirees prefer to keep a portion of their portfolio flexible, choosing shorter-term CDs or other investments that allow them to adjust as rates change. For retirees with more conservative financial goals, those who don't want to take risks and prefer a steady income, locking in rates might be the best choice. On the other hand, retirees with a larger nest egg or those who can afford some risk might prefer to keep some flexibility. By opting for shorter-term CDs or a mix of fixed and variable annuities, they can take advantage of rising rates without committing all their savings to a fixed rate. It's also helpful to consider different personal situations. Take a retiree who is primarily concerned with covering everyday expenses like groceries, utilities, and medical bills. They might lean toward locking in a stable rate through longer-term fixed income products to ensure these essential costs are always covered. Meanwhile, a retiree with additional income sources, like a pension or rental income, might feel comfortable keeping some of their investments flexible, ready to adjust as interest rates shift. Ultimately, the decision to lock in or stay flexible should reflect your financial priorities, risk tolerance, and income needs. It's about finding the balance between securing a steady income and remaining adaptable to market changes. Next, we'll explore some practical tips for managing your retirement portfolio, focusing on strategies to maintain stability while staying prepared for the unexpected. Practical tips for managing your retirement portfolio in 2025. Managing a retirement portfolio in 2025 requires careful planning, but with the right approach, retirees can maintain financial stability while staying prepared for whatever the market brings. One of the most important tips is to diversify your income sources. By spreading your savings across different investments, such as CDs, bonds, dividend-paying stocks, real estate, and annuities, you reduce the risk of relying too heavily on one income stream. If interest rates fall and bond yields drop, for instance, the dividends from your stocks or the rental income from a property can help balance things out. Another key tip is to regularly review your portfolio. Interest rates, inflation, and market conditions are always changing, so what works for your finances today might not be the best strategy a year from now. It's a good idea to check in on your portfolio at least once a year to see if any adjustments are needed. Maybe that long-term CD is maturing and you want to reinvest at a higher rate, or perhaps your bond portfolio needs tweaking to better match your income needs. Staying proactive ensures you can make changes when necessary, rather than reacting to sudden market shifts. Consulting with a financial advisor is also crucial, especially as retirement finances can become more complex. A trusted advisor can help you navigate these changes and provide tailored advice based on your specific goals and risk tolerance. Whether you're unsure about locking in interest rates or considering alternative investments, having an expert to guide you can make all the difference. An advisor can also help you explore strategies for tax efficiency, maximizing Social Security benefits, and adjusting withdrawal rates from your portfolio. When it comes to managing your portfolio in 2025, flexibility is key, but so is keeping your core financial goals in sight. A balanced approach that mixes stability with growth potential can help ensure you're well prepared for both rising and falling interest rates, while also securing the income you need for daily expenses and future plans. As we wrap up, it's worth remembering the key points. Diversify your income sources, stay on top of your portfolio with regular reviews, and seek professional advice when needed. By following these steps, you can feel more confident about your financial future in 2025 and beyond. Preparing for 2025 and beyond. In summary, the impact of rising or falling interest rates on retirement savings is significant, but manageable with the right strategy. For savings accounts, higher rates can mean better returns, while lower rates may encourage you to explore other income sources. Bonds offer stable income, but are sensitive to rate changes. Rising rates can lower bond values, while falling rates boost them. With CDs and annuities, locking in a rate provides security, but there's a trade-off if rates go up later. It's all about balancing stability with flexibility. As you look ahead to 2025, remember that staying informed and adjusting your strategy when necessary will help you navigate these changes. Diversify your income sources to protect against fluctuating rates. Review your portfolio regularly, and don't hesitate to consult with a financial advisor to ensure you're making the best decisions for your unique situation. By staying proactive and flexible, you can protect your financial future while still seizing opportunities for growth. If you found this video helpful, don't forget to subscribe to the channel for more updates on securing your financial future. We're here to help you stay prepared and confident in your retirement planning.